Hey guys, so welcome to my channel. So many people have been asking me about a strategy that works like about 70 or 80% of the time, or something they can rely on for a longer period, or they can basically use these steps on their own strategy to make it to make it more better, right? So, without wasting any time, let's get straight into the video. So, before I show you the strategy, these are the three steps we have to follow before we determine anything, right? So, let me just first tell you about the three steps, and then we will go to trading view and implement it on real time. All right. So, let's see. The first would be mark out the previous day highs or lows. So, let me just draw something. So, the previous day highs and lows. So, let's say these are the candles. All right. These are the candles. And so you basically have to go into the day time frame. The time frame will be day. All right. And you basically have to mark out the previous day highs and lows. So the previous day highs and lows would be this candle. So this candle, the previous day highs and lows. So basically, you have to this is the most simple step, and this is the most effective step. The reason why we are doing it is because we want to know when today's price broke the previous highs liquidity. So this is basically the buying side liquidity, and this is basically the selling side liquidity, right? So if our price hit this and crosses this position, so that means that the price has broke this area's liquidity, and there's a high chances the price will go up from here. All right. Now let's come to step two. Let me just remove all this. What is a fair value gap? So let me just tell you what a fair value gap is. Wait, let me just show you an example of what a fair value gap is. Wait, give me a moment. So let's go to a day time frame. Shit. All right. One sec. So let's just go to the time frame, and you'll see that there are irregularities in the market. What are the irregularities? So let's see. Okay. So this is the candle. This is a 1 day candle, and this is another candle. You see a huge drop over here, and you see in middle there is nothing, right? There's no candle like clearing this part. So this means that there is a huge liquidity sitting over here, right? Huge liquidity sitting over. The price might touch this position and go down, or if this position is broken, then the price will go up. So this is the irregularity, and irregularities always get fixed. Okay, so what happens? I'll tell you. So when there is the irregularity in the market, the price will always try to fill this gap, no matter what. It will always try to fill this gap because it's an irregularity. That means there's money sitting over here, right? So it hasn't touched yet, but it is going to touch it. So two things might happen. So the price might come into this part and it's going to bounce down, or it's going to broke this part and it's going to go up, right? So these are the things that might happen. Now, fair value gap, either a fair value gap is broken or it is maintained. So what is maintained is basically this is a selling fair value gap. As you can see, there is irregularity in selling candles, right? So when there is an irregularity in the selling candles, we normally say that this is a selling fair value gap or bearish fair value gap, right? So the price might come over here and respect this fair value gap and go down, okay? Or the price might come over here or do not respect this fair value gap and you cross this. So you have to keep one thing in mind: you should never trade in between the fair value gap. Never ever. Okay, when the price is over here, let's say the price is this price is over here. Okay, and it's just doing resistance. It's not crossing this part, it's not crossing this part. It's just doing resistance. You should never trade. Only if the price breaks this area or respect this area, only you will trade. So if it respects, that means you will basically be selling, or if it's breaks, that means we'll be buying, right? So over in this position, as you can see, the price respected this fair value gap. The price respected the fair value. See, this is the selling fair value gap. It came down, then it gone up, then it respected the fair value gap, and then it gone down. All right. So this is what a fair value gap is. Now there is also buying fair value gap. Let me just show you one buying fair value gap. All right. So this is a buying fair value gap. That means there is the irregularities in the bullish candle. So basically, when there is three bullish candle, and in between the first and the last bullish candle, if there is space, like this is the space, as you can see, the end of wait, maybe one more. The end of this fair value gap and the no yeah, the starting of this fair value gap and the end of this fair value gap, if there is if a candle, sorry, if the starting of this candle and the ending of this candle, if you see there is a gap between, it is basically a fair value gap, which means there is an irregularity in the market. I'll basically tell you, you don't have to find each and every fair value gap. There's basically indicator. uh, there's basically an indicator. How do you see an indicator? Okay, just go to indicator and search for fair value gap, and just click the Lux algo one. If you click, you will see this kind of bars in the chart. So if there is a bullish fair value gap, you'll see a red gap. If it's a bullish fair value gap, then you'll see a green gap. All right. So this is basically fair value gap. Now we'll come later what this fair value gap will help in our strategy. Now let's go for step number three. Step number three is find out liquidity pools. So I'll basically tell you what liquidity pool is. So let's say this is a candle. It's going up. All right. It's going up. Now, this is a liquidity pool. 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 Like this is where basically a pool of money sitting. Okay, a pool of money basically stop losses, people's stop losses. So let's say I am an operator, okay, and I just know that people have bought heavily over here. They people have sold heavily over here. All right. So what I'll do is I have so much of cash, right? I have so much of money. I have unlimited money, unlimited money. Now, what I'll do is I'll basically drive up the price so that it hits the stop loss. So the stop loss would be somewhere around here, okay? And my price will go above this situation, and basically I'll profit off the stop loss. So basically, let's say if three people got stop loss over there, and the three people are worth like $10,000 each. Okay, if I can hit the stop loss, I'll basically get $30,000 of profit. So there's basically stop loss of other people, and what I'm doing is basically I'm driving up the price and hitting the stop loss, so that hitting the stop loss. So that means money will flow into the market, right? So your money will flow into the market, and basically I'll get that money, and then I can again come over here and again sell. This process continues. I'll basically show you an example how liquidity pool works. All right. So let's see. Let's take over this position. All right. So this position would be, let's say this is the stop loss. Now the people who have bought here, they came here. Now an operator decides that, oh, this guy, not this guy, but these people might have bought somewhere around over here. Shit. One sec. So these people will, like, you will know because there's a huge gap up. See, the price has been going up, going up, going up, and this is the liquidity sweep. As you can see, there's a big downside candle. That means the operator tried a big liquidity sweep. Now, you have to notice one thing over here. When the price reached this position, all right, the bar came down a bit. Now, this is basically the profit. This is basically operator's profit. Now, what you have to do is you have to find these key liquidity areas where people might buy or sell. All right. So once you find out, I'll show you a real-time example how you can find out this liquidity pools. So it will be very easy. So you're basically trading with the operators, not against them. Right. So I want to show you again another liquidity pool. So over here, see, people who have bought, all right, so people who have bought, see, the price is going up, 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 and then suddenly a huge drop over here. That means people who have bought here, their stop loss got hit over here, or they might have sold, right? So operators did a profit over here. Now, let's see another example. All right, let's see over here. See, this is people bought here because people might have saw a big candle. Now this is basically a trap. Now what operator does is they will show you a big candle. Now you'll think the price is very bullish. Then they'll people who will buy, they will drive up the price. The operator has unlimited money. Okay, they have unlimited cash. They will never run out of cash. So they what they basically did is they drive down the price over here, but they couldn't touch this. They couldn't touch. This is the liquidity. Most people have set their stop loss over here. So what it did is it came over here, then it again did a trap trading. See, it showed that it followed the resistance. This is the resistance, right? No, sorry. Yeah, this is the resistance. So they showed that the prices again followed the resistance. They went up. Then they again tried to take down this position, but they couldn't. They were unsuccessful. Then they again drive up the price. Then they did a steep fall. All right. Now you're going to ask question, if they have unlimited money, they can literally drive up the price up and down wherever they wish, right? So why not they drive down the price from here to here so they can had a like a hefty profit? Why not that? So the answer is very simple. Even they have unlimited money, the shares are not unlimited, right? So these are all. So this is gold spot, right? So let's say the gold market cap is $3 billion. $3 billion. All right. Now I have $1 trillion. I have $1 trillion. I cannot put this entire $1 trillion in the market because the market cap is only 3 billion. Right? But this entire 3 billion is not mine. Now, this entire 3 billion, many individuals have bought it or sold it. Right? So I can only buy few. The shares are limited. Shares are limited. There's a limit to shares. There's a limit to number of shares I can buy. So that's the thing. They fail to take the liquidity. So this is what liquidity pool is. Now let's come to real time examples and see how we can implement this strategy to make bucks. All right. So we'll just have a practical example of how this strategy works. All right. So the first step would be to mark out the highs and lows of our previous day. So as you can see, this is GBP AUD. We have marked out the previous highs and lows. Now let's go to 4 hour time frame. Now you have to mark out the fair value gaps at the 4 hour time frame because that is when the fair value gap is more strongest, right? So here's another fair value gap. Let's shift to 15-minute time frame to see our trade. All right. As you can see, the price has came over here on this part, then again on this part, and reflected, right? So what we have learned is how to determine liquidity. Is that so? Now let's analyze this portion. This portion. All right. So, all right. So the price came up over here, created a fair value gap. Then it again retraced. See, as you can see, it didn't cross the fair value gap pretty much. Like there's a little bit of marking problem. I'll show you. See, the price didn't. One sec. Price didn't. Okay, so this is the correct measurement. Um, so let's go to 15-minute time frame. As you can see, this did not cross the fair value gap. So that means our price is maintaining or respecting the fair value. Right. So let's analyze this part, only this one. Right. So let's see. The price came over here, then went up. All right. Then it respected this fair value gap. Then it again came down. Now on this portion. All right. Now in this portion, it came down and reflected. Let's go to 5 minutes time frame so I can show you better. All right. So the price came over here and did a trap movement. So what is the trap movement? This is a trap movement. See, the price came over here, respected this, and went up. So now again the price came down over here. All right, again went down. So that means it is respecting our fair value gap, but we have to see something over here. First of all, the people who trade fair value gap already had placed their position on this part. All right, because this is where they get the confirmation that price will go down. Now, this is the position where most people will set their stop loss. Yes, sir. Okay, because people who trade fair value gap, this is how they trade. They basically put their stop loss at the bottom of the last candle. So this is it, and it came down pretty much over here. Then it came down. Now how we will find out the liquidity, our second step. Okay. The second step would be how can we find out the liquidity? Is that in this position, as you can see, it came down, touched this fair value gap, came up over here, right? So that means it is also respecting this fair value gap. So people who trade the fair value gap also traded this. That means our liquidity is sitting over here and also over here. Okay. And our liquidity is also sitting on this area. So now there's three areas where our liquidity is sitting for this current position. Now, how we will know or determine that the price will either go up or take this area, or the price will again go down and take three of these areas? How will? So to know this, we have to first go to a 4 hour time frame and just see that what is the daily bias. So the daily bias is pretty much like non-conventional. That means the price is basically um, retaining between these two fair value gaps for the last hour. But if you overall see, it is in uptrend. It is an uptrend, right? So only in this position it is like retrieving, means it is grabbing liquidity. So on based on this theory, based on this uptrend theory, we'll know that the price will go up. All right. We cannot like we're not God, okay? We are traders. What we do is we check out all the possibilities and trade on behalf of them, right? So this says that the price will go up and maintain its uptrend. All right. So now let's go to 15-minute time frame and see one. I just want to check one thing is that there is a fair value gap over here. Okay, and the price is pretty much maintaining this fair value gap. As you can see, the price is pretty much following the fair value gap. That means there is a chances that it might take out this three position first and then go on. All right. How can we get the confirmation? So the only way we can get the confirmation is when this price break this area, break this two area, right, and come down below. So that means that it took all the liquidity and the amount of liquidity is sitting here, and I'm pretty sure it will also take out this liquidity, right, this area. So what I'm hoping is I'll not do any kind of trades right now. I'll just go to 5 minute time frame and see one thing. See, there's one candle which is pretty big, and then second candle, and I'm waiting for third candle to cross this top. All right, so we will know that this price will not go above. Okay, if I see a big move, like a sudden jump, that means the price will take this or these three. But what suggesting is that the price is pretty much conventional, like the price is going like this, right? So I'm positive or I'm pretty much sure that price will either break the uptrend or follow the uptrend. So we cannot really just say anything. Now, how can we trade in these situations? This is like one of the most difficult situations right now. So wait, let me just remove all this. Let me just remove all this drawing. Let me see this. Wait, is there any eraser? That's there might be an eraser. I don't seem to find any eraser, but this is for our own view. So there's one liquidity setting here. There's three liquidity setting here. And I'm hoping the price will go down. Right, let's go to 5 minute time frame. Uh, all right. So on the 5 minute time frame, what we can see is that it's taking more time to go up than rather going down. So that means the downtrend is pretty much high, right? So as you can see, the 5 minute candle didn't really form. So we only take trades on this kind of candle, on these three candles, on this big candles, right? We only take trades. So we'll just wait and watch until something happens. We cannot really just blindly trade in these positions. Once our price reach over here or again over here, then we'll know that the price will go down or up. If it reaches over here, that means it's pretty much sure that it will take out this position because from this area, from this position to this position, it takes a lot of liquidity, right? And it doesn't have a liquidity because it is conventioning right now. So, wait, okay. Alright. So we'll just wait and watch and see what happens really on this one. So once it reaches this position or breaks something, we can do the trade. Right, guys. So as you can see, the price has been rejected from here. So that means that it will pretty much go down because it doesn't have any like um, proper what do you say proper like more number of stocks to go up, right? So it's basically rejecting at this point, so that means it's a very strong move that the price will go down. So I'll basically take a trade over here. Just let's go to paper trading for now, and then we'll jump into so let's go to order market. Let's sell. Alright. So we sold, and now let's see if our price reaches in this two position and gives us a good amount of profit on all.